Good morning, everyone. The market is open, and today I'm breaking down the trade I'm taking this week, the fundamentals, the setup, the technicals, and the exact spread I'm using. Quick disclaimer, this is not financial advice. I'm not a financial advisor. I'm just a guy with some capital to burn and a dream. The stock I'm targeting this week is Dollar General, ticker DG. Earnings are tomorrow. Implied volatility is exploding, and that creates one of the best environments for premium sellers that we've seen in months. So let's break down why this setup is so interesting. Before we talk options, let's talk fundamentals, because Dollar General has been on a roller coaster. Over the past year, Dollar General has faced margin pressure from shrink and higher labor costs, slower same-store sales growth, inventory management issues, and a major CEO transition. But here's where it gets interesting. Even with those challenges, Dollar General sits in a category that historically outperforms during economic stress. Right now, consumers are feeling it. High interest rates, rising gas prices, and global conflict pushing up costs. When people feel squeezed, they shift spending towards inferior goods, the cheaper alternatives. And what does Dollar General sell? Exactly that. Analysts are expecting stabilizing margins, better inventory controls, and possibly a guidance reset. All of that creates uncertainty, and uncertainty fuels implied volatility. According to bar chart, DG's IV rank is at 100%. That means implied volatility is at the highest point it's been in the last 52 weeks. And high IV means expensive options, and expensive options are ideal for premium selling strategies like spreads. Now let's talk technicals, because the chart actually supports this trade. Here's what Dollar General is showing going into earnings. It's been consolidating after a massive sell-off earlier in the year. The $100 level has acted as a strong support multiple times. Buyers keep stepping in. The 50-day moving average is flattening, which often signals selling pressure is cooling. And the RSI is sitting in the mid-40s to low 50s, meaning the stock isn't bought or oversold. This is exactly the kind of chart you want when selling a bull put spread. Not overly bullish, not breaking down, just stable enough to let theta do the heavy lifting. So here's the plan. I'm selling a bull put spread at around a 0.2 delta. A 0.2 delta means there's roughly a 20% chance the option finishes in the money, the losing scenario. But this trade has positive theta, meaning time decay works in my favor as long as Dollar General stays above my short strike. The spread decays and I keep the premium. This is a classic high IV earnings setup. Sell premium when it's inflated, let IV crush and theta decay work together, and keep risk defined with a long put underneath. Here is the exact spread I'm placing. I'm selling the $100 put, buying the $95 put. That gives me a probability of profit of 79%, a max profit of $86, and a max loss of $414. This gives me a risk-defined bullish position heading into earnings, taking advantage of elevated implied volatility while keeping my downside capped. If you found this breakdown helpful, fundamentals, technicals, and the trade, hit that like button so YouTube knows this content is worth pushing out. Trade smart, manage your risk, and I'll see you in the next one.